Okay, so once again, good evening, brothers and sisters. Good evening from Lusaka. Good evening to Nairobi people. Good evening to guys from the West uh, and anybody from Europe. Today, we are going to discuss a little bit about how the big banks trade and why it is of any significance, at all. Um, the perception normally when you go trading, you think you're the only ones trading, but actually, it's the whole world. And I think I had indicated in the earlier trainings that in the forex market, a good chunk of it, let's say a good uh, like 40% or something, is what you call the big banks, where the big banks are the um, HBS, HBSC, there's Citibank, there is the Barclays, there is all those big worldwide banks that you hear about, you know, um, Chase, worldwide. So those are the big banks, okay. But then there are also other financial institutions. You see, the forex market is made up of I'll call them corporate traders, where the corporate traders are the banks. Then there is institutions that are investing, like insurance companies, the big ones. Um, then, apart from insurance companies, then we have other companies that are big and move the markets. So those are like the bulk of the traders. And then the people like you and myself are called retail traders. And retail traders are not very many. Well, we only, I think, about 26%, not too many. Um, and essentially, we kind of, for lack of a better word, yes, we are the majority in terms of numbers, but in terms of quantity or the volume of money we move, you know, we move the least amount of money. So the most amount of money is moved by the big banks. Okay, and that's why it's important. It's important for us to know, who the big banks are and how they move the market, or at least how they affect the market. So welcome, and that's why I think it's important. Now, what do we need to know as far as the big banks are concerned? All right, we're gonna go to the next slide. Okay, so these are some of the I call it things to know about big banks. So big banks trade higher time frames. Okay, they because they move lots and lots and lots and lots of money, so they can only do higher time frames. They can't do the smaller, like 1 hour, 15, 30 minutes, you know, or the scalping of 5 minutes and so on. So they do larger time frames. And the reason for that is most of them work almost by order. For example, if central bank in Kenya decides that they need to inject maybe 1 billion into the economy, um, then they make the order from their suppliers of quote unquote dollars in wherever they get the dollars from, whether it's Barclays Bank, UK, or Citibank from the US. They make their order like a day in advance. Okay, so that tomorrow there'll be a big volume of maybe a billion, $1 billion or 500 million dollars being moved to the Kenyan account, the Kenyan central bank. So that's a big chunk of money being moved, but it can only be moved on a higher time frame. So maybe on an emergency, maybe something needs to happen in the afternoon, and this is early in the day, then the big banks can request, that a certain amount of money be moved, and that's why they trade only higher time frames. So they can only move like big chunks either once a day or twice a day or something like that, depending on the urgency. Now, they are carriers of high volumes. I mean, we're talking about billions. And because of that, they actually cause liquidity. They cause movements, big movements in the market. Those big movements you see is normally like if you look at the charts, and suddenly you see a big spike in the market. Usually it is because one of the big banks or the big banks are moving money or money is being moved. So you find that maybe the market was going down very slowly, down, 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 and then suddenly it shoots up and then moves back a little bit and then shoots up and then moves back a little bit and then shoots up. Now, that usually is an indication that there's money moving, lots of money. The big boys are playing. They are basically, and this is very common towards the end of the week. Towards the end of the week, where maybe they had a quarter, they maybe need to sell off or buy certain dollars before the weekend. So they have to push that money into the market. Okay, and when they push the money, this is the effect. Okay, so large amounts of money. I told you on a daily basis. Right now, last year it was like 5 point something. Now they're saying the daily volume is over 6 trillion dollars per day. Now I don't know how you can imagine or how you can think or how you can you know uh, conceptualize what $1 trillion is. But okay, let me give you an example. The U.S. stock market, the New York stock market, or maybe let's come near at home. The London stock market. The London stock market on a daily basis moves only about 22 uh, billion billion dollars. That's daily. All right. The US, I think, is slightly lower than that. Okay. So you can imagine all these big financial markets, whether it's New York, whether it's London, whether it's Sydney, Australia, all of them put together, plus even the GDPs of the countries put together, are nowhere close to the amount of money that moves in the forex in a daily basis. So $6 trillion on a daily basis. So that is why people say, the place to go, the place to make money is in the forex market. It's not even in the stocks. Some people go and do stocks, do other things, blah blah blah. No, the biggest money is in the forex. Okay, because logically, it is the forex that makes the world move. Okay, the worlds have to trade. The world has to trade with each other. Each country has to keep trading on a daily basis. So the countries, it's like moving. Kenyans want maybe dollars. Zambians want dollars, and in exchange they give back. So and these countries have to keep moving money every day, and so the forex market is more of a central exchange for all these currencies moving up and down, and that's why there's a lot of very high liquidity. Third point, why the one of the marks of the banks is they trade, but they trade in small portions. Okay, I guess that was a typo. They trade in small portions to avoid spikes. Okay. You know what a spike is? Like what I was trying to show you. They trade in small portions. Uh, portion. Hence, avoid spikes. All right. So if the banks were to wake up one morning and go to the market and decide, okay, I'm just going to pour all my money in the morning because I'm in a hurry, I want to do A, B, C, D. No. If they did that, the markets would be something like this. I mean, I'm not saying it's never been like that, but it would just be like that. Like that. Okay. So they can't just pour all the money like that because they also have to, you know, they have to allow the traders to buy. You have to allow them time to buy. If they're going to pour in the money there, somebody has to buy the money. Okay, so they buy and sell. Okay, so to avoid those spikes, so what they do, they have to pour them in portions. A little bit, then hold up a little, then maybe a little bit, and then hold up, and then a little bit, and so on. Okay, all right, and the last point. Oops. Okay, so that was a last big point, but now we can go to the charts and describe really their behavior and how we should trade them. All right, so before we go to the charts, I just want to explain in brief how it happens or how they actually make it happen. Okay, I think the red color is good enough. So what happens is traditionally, um, maybe assume the banks are buying. Okay, when they're buying, that we're going to have two things. We're going to talk about the banks. Okay, B for banks, and then we talk about retailers. We'll use letter R. So that's banks, and then retailers. That's you and I. Retailers. It's very hard to write using these things. Retailers. Okay, we'll use letter R. So for you to maybe buy or sell, the bank must be doing the opposite. So let's start for the sake of argument that the banks are buying. When they're buying, they're flooding the market with money. Okay, they're flooding the market with money. What normally happens is retailers are quick to jump in and start selling. All right. So when the banks are buying, usually the opposite happens. The retailers are selling. So they're selling. Okay, so the banks are buying because the market is going up. Now, here's the funny part. As they keep buying, these guys keep selling, believing that now it has peaked, you know. They keep hoping that, you know, it has peaked. We're almost getting a turning point. So they keep selling. Sorry. So this keeps going up, but they're busy trying to sell. At some point, most retailers decide, oh, wait a minute, this market has run away. So we can't keep selling if actually seems like it's on a trend. It's going up, 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 up. So what do the retailers start doing? They decide they give up because as they keep selling, the bank stop them out. Okay, they keep buying. Selling. The bank stop them out. Then essentially, when they stop, and decide, you know what? I think I better start doing a buy. Okay. So they start buying. Why? Because they believe that the market is still gonna go up. And usually that happens towards the end of a long ride. Okay. Now, unfortunately, the banks at that point decide that because they see there's a, what do you call that, like a support, uh, a resistance level, the banks now decide they will start selling. They will start selling. Okay, because they've offloaded a good chunk of their money. Now they start selling. Yeah. When they're selling, remember these guys who are doing sell, 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 and halfway through they realize that this market is actually on uptrend, so they decide they want to start selling. But unfortunately, when they're starting to sell, that's about the time when the banks, okay, sorry, when they start buying, that's when the banks are starting to sell. Okay, so what is this? The meeting saying, wow, the WebEx has never given me a warning that the meeting is ending in 5 minutes. I've never seen that before until today. So anyway, we'll try and manage the time and see if we can. If it goes off, we'll have to relog in again. So anyway, so quickly, as the market goes up towards that point, the banks start selling while retailers are buying. Okay. Now, when the market hits up there, the bank is still selling, still selling. Well, the retailers, for some strange reason, are still hoping that yes, the market is going up, okay, and they're still hoping that somewhere along the line, okay, it will continue going up. But now, unfortunately, the market has already changed. The banks are now selling. All right. Now, this is a very funny phenomenon because every time the market goes up, the big banks would initially be buying, and somewhere more about halfway through, before the end of it, okay, they will stop buying. Why? Because retailers will jump into the trend, believing that now they are still buying, when the banks instead will start selling. And the retailers do the opposite. When the bank is buying, they are busy selling. Why? Because they keep hoping that they will be reaching a turning point, okay, where it will start going down. And then after the trend is almost like more than halfway or has gone already, then they jump into the trend and thinking, okay, I guess it has been going up, so let me continue buying here. I've lost enough money trying to sell, trying to sell, trying to sell. Let me start buying here. But unfortunately, by that time, the banks are now switching gears. Now they are starting to sell. So they are selling when the retailers are buying. When the trend changes direction, the same thing happens. So the big banks now are selling. Okay. So if you look at the market, the way it goes, so it's coming down. Sorry, this thing is very hard to use. It goes something like that. So as the market goes down, because the big banks are busy selling, usually the buyers still, I mean, the retailers still believe that the market will still go up. So for a while, they keep buying, thinking that, hey, this market will still turn up and go that way. And occasionally it does, but usually it is what the market says, what the banks say is what happens. So as a retailer, you are buying, you're thinking this thing is going up, but it keeps going down. You think it's going against you, that somebody's moving it. No, but it's the banks. The banks are doing exactly the opposite of what you are doing. So you keep buying, and then finally you realize, whoa, this market is just going down continuously. It's not about to turn. So what am I going to do? Well, at some point you give up the buys because you've been buying, and you decide, no, I think I better start selling. Now that's where you go wrong, because now the banks have already offloaded their first bit. Okay, they've probably offloaded the second bit. Okay, and now they want to start buying. So as you're busy starting to sell, they start buying. They start buying, 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 buying. When you get down, okay, you, on the other hand, who was selling, suddenly